But in the bear market, that's called sucker's gap. So what I mean by that is like if it gaps up and then it just like runs into like resistance, they always fade off. It always, in bear market, that's a fade spot. How do you know when to go long, short, long, short? Like, how do you know which directions to pick? You always want to check the areas where the QQQ's overall market can have resistance and support areas. But you also want to think like in common sense terms. So if you think of like common sense terms, if you get a multi-day bounce, in the market, but you smack into a moving average, that's usually a spot to actually come back and short. But what happens is because you had a multi-day bounce, people feel pretty good about the market, so they keep buying. And then the rug gets pulled. Remember, in a bear market, spikes get faded, not dips get bought. It's the same thing, just in reverse. So you want to check like where your overall levels are in the QQQs. You want to also see like what was happening the previous day. What's the high of the day, low of the day, and any major support and resistance levels. Then you got to assess the pre-market gap. Is it a light gap? If it's a light gap and you had a trend today the previous day, then you're playing for red to green, green to red based on that previous day. If you have an exhaustion gap, which means like a big, big gap followed by multiple down days already in the market, that could exhaust all the selling and then you could get a quick counter trend trade. And then, of course, if you have strength in a bear market, and you've seen this now, like how many times? You have strength in a bear market. What I mean by strength in a bear market, and this is where it gets people. So even in my boot camp, right, I teach my students, like when we have a gap up on something, a gap up on a stock, for example, it's a bullish thing. And it is in bull markets. But in a bear market, it's the opposite. So like what I mean by that is like, for example, in a bull market, if we had a stock like NVIDIA today, gapped up today, all right? Now, I call that a sucker's gap. So what I mean by that is like in a bull market, we actually look at those gaps and we want to try to long them. We want to try to long them. We want to wait for a pullback or some opening range to develop. And we actually try to long these things. We actually try to long these things. But in the bear market, that's called sucker's gap. So what I mean by that is like if it gaps up and then it just like runs into like resistance, they always fade off. It always, in bear market, that's a fade spot. In bear market, that's a fade spot. So that's a long setup in a nasty market, but in a bear market, it becomes a short setup. So we want to assess where these gaps are and then really think about like, hey, where are they opening into? So when we think about the opening in terms of the indexes, we want to look at the indexes in a really, really similar manner. So what I mean by that is like if you look at like, say, the QQQs, for example, a couple days, yesterday, like see how like you kind of spiked up right here? And so like, we had like a big update in the market. And then, yesterday into the Fed, we had like a little bit of a spike up after the Federal Reserve came out with their news, but it just ran into the 9 EMA on the daily, and then you completely ran over. And that's happening all the time. Like if you look at these previous days here in January, like you had a nice bounce and everybody's thinking the market is like all hunky-dory. Nobody uses that term anymore, but they should, right? So like you had a nice 3 days over here, but you ran into resistance. Look how big the down day was. You just ran into resistance and then it's rug pull. And that's been happening a lot. Like you get 3-4 up days and then it's a rug pull. And so we want to be assessing based on what the QQQs is doing and where the support and resistance areas are, and then start to pick directions. And the majority of the time, obviously, it's just been shorts because we're in a bear market. Now, however, we still need to monitor price action at the open to confirm direction of the gap and what type of intraday trend we will have afterwards. Hey, Aaron, what's up, baby? Yes, I don't use MACD or RSI because I use the chopsticks because I'm looking for overbought, oversold. RSI is not really effective for overbought, oversold because it's actually a relative strength indicator. It's meant to really, theoretically, it's meant to spot divergences, not necessarily overbought, oversold. But there was one jerk, and I won't even name his name. There's one jerk who wrote a trading book like 10 years ago, and he thought he must have not had an editor. I doubt he trades, but he put in like, hey, RSI is how you look for overbought, oversold. And then everybody started talking about it, but that's actually not the case. So let's talk about when to go long, when to go short. So if you look at the day the market broke recent lows and it bounced hard in the afternoon, we can see like how NVIDIA has a great range and trades alongside the direction of the tech index for a majority of the time. So when we have confirmation from the market, we can apply our intraday setups that we teach at our boot camp for all of these things, whether it's ORB, pullbacks to VWAP. I've got 18 different trading patterns that we can use. They don't all apply to every single market, right? There's 4 different market cycles. So I have different trading patterns for different markets, but we have a whole host of them that oh, my bad, Josh. We have a whole host of them that we teach, in these bad boys, but we really do want to line up where the indexes are, where the stock is, and that's really how we start to try to trade these things. So when we're thinking about when to go long or short, like this is something we were trading off today. When the QQQs are busting down, that's your general index. That's when we also are starting to take our stocks down at the same manner, looking for trading patterns. So you can't just blindly take something down. You want to start looking for trading patterns that start to go up. So the focus has been mid, large cap tech, auto, consumer stocks, no small caps, and tech. We've really been trading a lot of the same names over and over because they have the biggest range and the most liquidity. Out of 8,000 stocks in the market, probably only 100 are worth a damn right now to actually even look at. And I would say maybe only 50 of them are even tradable, which is kind of awesome because it makes your homework a lot less. In a bull market, there are stocks that are like hidden gems and things that are coming out of nowhere. And so in bull markets, we got to do a lot of research, and I use software and stuff to find the names, but like you're spending a significant amount more time hunting around and looking for stocks because you got to go through and filter through 8,000. But in this market, there's really only a handful that are worth a damn to trade. So it ends up being pretty cool. Like we don't got to do much. And the good thing is like while I'm trading today, I'm live. I'm on Zoom. I got a Discord room. I'm like typing in what I'm doing and selling and letting everybody know. But I'm on Zoom. I'm hooting and hollering and singing and dancing the whole time. Same type of deal. When to go long or short. So if you have the QQQs, you start to break down, right? See how like you start to bust lower and start to speed up? That's when I'm loading into shorts. Like I shorted this SC here right around 134 and some change. But like I waited on this till I started to see the market start to speed up. I wanted to see that 9 EMA really coming down on it because I knew it would speed up the market because the market was showing some like fake outs where it looked like it was getting heavy. But like that, see how the 9 wasn't curling down on the kitchen on it? So I knew that there would be no speed up. So like I abstained from shorting till that speed up started to show. And then you put the wood down on these things and time them.